Yes. Hello there. So, Hilliard MacBeth, did I say your name right?
That's right.
Hilliard. Okay, great. Thank you for joining us today and agreeing to do this live stream event with the Real Estate Investors Club. And I just finished reading your book, actually, which was very interesting. And it has some perspective that maybe, at least in the Montreal market, which has been very hot lately, we don't talk too much about bubbles and about where we are in the real estate cycle. People speculate, but I feel like there's not a whole lot of data. So I'm excited to hear from you today as to what your opinions might be on the investment climate and what's going to happen. So do you want to maybe tell our listeners just a little bit about your background and maybe just 2-3 lines about your book?
Sure. So thank you for inviting me on the meeting with the Real Estate Investment Club. But I don't get too many invitations from real estate investment clubs with my bearish view. So why did I write the book? So I've now more than 40 years as an investment advisor, and I noticed that my clients, starting in about 2000, 2001, were getting more and more interested in real estate, and it got to the point where parents wanted to buy apartments for their kids when their kids graduated from high school and stuff, and I found myself pushing back against this because I was more concentrated on the parents' need for retirement funds for their own retirement, and so I after about the 15th time or something that I got this, and they didn't phone almost every other investment decision, including buying a car, believe it or not. After you develop a long-time relationship with a family as their investment advisor, portfolio manager, they will consult you ahead of time. But this is the one emotional decision where they would go ahead and do it, and then afterwards phone up and say, "Oh, by the way, I need $100,000 from my account." So, I mean, from their point of view, they think they have $2 million in assets for retirement. They're in great shape, but $100,000 is nothing, right? It's only 5%. But from our point of view, of course, we don't like to lose the assets, but also we know that it takes a long time to save up 100,000, and if they're 10 years away from retirement, in 10 years that could be worth 200,000 or 300,000, or really help a lot in retirement. So we tried to push back, but it was very difficult, and we tried to ask. Actually, one incident sticks in my mind. Actually, it was a very well-off family, no problem. The son was qualified as a teacher, but he couldn't get a permanent job. It was a temporary job, and his daughter-in-law was a lawyer, but she couldn't get a job. She was working in legal aid, so nobody making any real money. And they had a baby on the way, and the parents said, "Well, we need 100,000. We got to help them buy a house." And I said, "Oh yeah," and they said, "Yeah, because they can't raise a baby in a rental, they're like that." And so, well, the baby's not going to know it's a rental, right? How the baby doesn't care. And then they said that one key thing which stuck with me was, actually our son and his wife, they don't really want to buy a house. So we had to talk them into it. And so I started listening to further conversations along this line, and I discovered that it was a lot of times it was the baby boomer parents that were pushing the
Okay.
kids into this. And now this was in Calgary, and this was several years ago. So the losses now would be on that purchase would be well above 100,000. I think the total purchase was about 700,000. So I'm for sure they're down more than 100,000. And now they're getting into the mortgage, and of course it gets worse because then if the kids get into trouble, they're 35 now probably. If they get into trouble with the mortgage, then they're obviously the parents are going to feel responsible because they pushed them into it. So I decided to look into this as an investment, from an investment, but none of the books really are about an investment. They're more about, most of them are mostly just promotional, written by realtors. But so I started looking at it as an investment, and then I got into economic theory, and then I did a second edition, which came out last year, and it added a whole new section on how can these bubbles keep forming and keep bursting, and the so-called authorities that we look up to, like the Bank of Canada, the Bank of England, and that the governments, the big banks, how can they all sort of be okay with this, where people's lives are really devastated because nobody wants to go through a situation of putting 5% down on a house purchase and then looking at a 35% loss 5 years later. But that has happened over and over and over again. The difference with Canada and Montreal is that it hasn't happened recently. The last time it happened was in the early to mid 1990s, and already history is getting rewritten. I don't know if there are any subscribers to the Globe and Mail on this, probably not, but I tweeted about it this morning, and they did a story. So the CMHC came out with a minus 18% forecast, 9 to 18% forecast for a drop in prices. And this was, shouldn't be a shock at all to anybody, but it was apparently. And so the Globe and Mail delayed a day until they reported on it, which was interesting. And then they had the real estate reporter, who almost always just writes positive stories about the real estate. She wrote it up and said the CMHC said this. And then she went to the two banks, the Bank of Montreal, the CIBC, and the Canadian Real Estate Association, and a realtor. And all of them said, oh, there's no way they could get a 9 to 18% drop in house prices. 5 to 10% would be the absolute maximum possible. And, it's just, and then they went and rewrote history, saying that in the last two downturns, and you have to go back a long way to the mid 90s and the mid 80s, the average price only dropped 5% across Canada. Now, I tried to refute that. However, CREA website only goes back only about 10, 15 years. So it's going to be hard to prove that that's incorrect, but I'm sure, because I lived through both of those downturns. Yeah. There were lots of prices that were down 30% or even more. And of course, there was no national average, so you could argue, I don't know, the CREA will probably win the argument in terms of the data, but it's crazy. So what I've learned.
I don't want to interrupt you, but I think maybe we can just start with, the thesis in your book is that Canada wide is currently in a bubble situation, and so the asset price of, I guess, really, first maybe let's talk about single family homes, then we'll move to talk about rental properties. But what exactly, if you could summarize for our listeners, what exactly makes you think that we're in a bubble?
So it's interesting, in the book I described that the bubble, there's no real technical definition of a bubble. So you have, but the Robert Schiller probably has the best definition, which is a period of rapidly rising prices beyond what the fundamentals support. And the second feature is that people get involved in tremendous anxiety about missing out on the rise in the house prices or in stock market. It doesn't matter. It could be any bubble. And the third thing is that the people start to make up reasons why the bubble makes sense. So none of these reasons are valid from a statistical or economic point of view, but they come up with justifications. And then the fourth thing that he mentions is that the media gets involved in writing stories about the bubble. So all four of these things have happened long since. I mean, we're talking 15 years now in Canada. But if you want to take a more sort of mathematical, economic kind of the main thing is the average wage income against the house price. So to give you some idea, and I think there's a chart, I don't know, but it shows that the house prices have basically tripled on average. Now, Montreal's a little bit less than a triple, and Vancouver's a little bit more than a triple. But if you go back to 2000, which is where I went back to in the graph,
it's based on the screen.
If you like, sure. Yeah.
Sure. Okay.
Yeah. So I don't know if people can see that, but it starts at 2000. The most obvious thing that stands out is the red line in the middle. So let's just leave that out for a second and come back to that. And then you'll notice that there's four lines there. So the sort of bold dotted line is Montreal. It's below the other two. The smaller dotted line is Toronto. And you can see on the right-hand scale there, the numbers are 300, 400. So the index on all of these started at 100 20 years ago. So 300 would be 3 times, 400 would be 4 times. So you can see the top one there is Vancouver at close to 400 or above 400. And Montreal hasn't quite made 300 yet. And the red line is the growth of household debt. So obviously you can't get a bubble without, in an asset like housing, where it's way more expensive than what people can save up to buy. without debt growing at a similar rate. And it's very clear that debt has grown at the same. It's about a 7% annual increase roughly. So to get a quadruple in 20 years, you need about 7.2% annual increase, and that's basically exactly what's happened roughly. So, but if you look at the bottom, so the very bottom line, the flat line there is the consumer price index. So we've had very little inflation over that period. If we have time, we could talk about why those tripling, quadrupling of house prices doesn't fit into the inflation line somehow, doesn't get put in there, given that shelter costs are the highest weighted component in the CPI. I rant about that in the book a little bit, but anyway, the second slightly paler line there is wages, and actually it's not wages, it's after tax disposable income. So that includes other things like dividends and interest and all that after tax. So that's basically what people have left over, and that hasn't even doubled. So you can see that the gap between the house prices and the wages has expanded dramatically, and these are phenomenal. That gap being that wide has probably never happened before in any country other than a few, and it's all recent. All of these are recent, by the way. People think these things have been happening forever, but this is very unusual. New Zealand, Australia, and Canada, and a couple other countries have managed to do this, but those are the only ones. And one of the things that goes with it automatically is the household debt level. So that there has to be a banking system that's willing to support it. There have to be rules with the CMHC and the Bank of Canada and other places, the central banks in Australia and New Zealand, that allow people to borrow that much to buy a house. There has to be rising prices because the bank by law cannot lend more than the value of a house. So if asset values start to drop, as they have in several major cities in Canada now, not Montreal, but other cities, then the banks will not be allowed to lend as much as they have been lending. And of course, that takes away buying power. So that's a bubble. That's a massive bubble. And the reason it's unsustainable is because all mortgage debt, and this seems so simplistic, but it's been completely forgotten in this whole thing. All mortgage debt eventually is paid out of wages and salaries and income. And it's not even paid out of investment income like dividends and interest, because most of the people that have mortgages don't have a massive investment account. I can attest to that after 40 years. So the people that are buying, the younger people that are buying, they basically don't have much in the way of assets. They might have a down payment. A lot of times they don't even have a down payment. They get help from the parents. So all of that mortgage is going to be repaid. And so just a quick story. I had a couple of things that happened early on that were really shocking to me. Several of the 30-year-olds that I know told me that they had been offered $1 million in mortgage debt in Alberta and in BC by banks. And I was just totally shocked. And then even more shocking to me was the fact that these people were actually considering taking that offer. They didn't like the houses that they could buy at $600,000, but they really liked the houses they could buy at $1 million. So, and I said, well, don't you realize that in those days the interest rates were more like 6%, or they had recently been 6%, and now obviously mortgages are down to 3%. So these numbers don't quite work. But to give you an idea, at 6.5% roughly, the total cost of a mortgage is double what it is on the initial. So if you borrow $900,000 to buy $1 million house, you're going to pay $1.8 million over 25 years if interest rates are 6.5%. If you borrow that much at current, let's say 4%, it's about 50% more. So 1.5 million, 1.4 million, 1.45 million. So when I asked the people that were telling me this, I said, do you realize that this means you're going to be paying like this amount of money over the next 25 years? It's like $40,000 a year over 25 years or something like that, or more, $60,000 a year over 25 years. And I just got this puzzled look back, so I kept probing, and finally somebody, the light bulb came on. They had no intention of paying back the money. They had no intention. They had the idea that they were going to buy the house at $1 million with a $900,000 mortgage. It was going to go up to $2 million. They were going to sell it. They were going to pay off the mortgage, and they were going to have $1.1 million left over. And from that point of view, that actually makes sense. That that doesn't make sense to pay back over 25 years, which is what earlier generations have done. But it does make sense. If house prices were to double from here, it would make sense to borrow 900,000 because it's a tax-free gain and all kinds of things. The problem with that, though, is if there's a whole bunch of people trying to do that, it's mathematically impossible for all of them to be able to sell their homes at $2 million at the end of the whatever period they're thinking. I think they were thinking a year, but obviously that's not going to happen. But even over 10 years, it'd be mathematically impossible, because if the gap between the disposable income and the cost of housing is already that wide, as we saw in the graph, wages are not going to go up any faster in the next few years. In fact, they're probably going to go down because of the recession. So it's going to get even more stretched, that valuation. So there's really no way that that the prices can go up and save those people. So that's an example of the type of thinking that creeps in during a bubble, which does not, outside of the bubble era, thinking like that did not exist, has not existed, will not exist, it cannot exist. It's only during bubbles, during a period of rapidly rising prices, that people start thinking that way.
Okay. So let me just see if I get this correlation right. So basically, like on the graph, and in terms of what you were saying, is that we have rising asset prices, like rising property prices, and that is basically being fueled by a debt bubble. So households, because wages are not increasing at the same rate as prices, it means that people are indebting themselves to a higher and higher and higher degree. And I guess your thesis is that at a certain point, that's going to hit some kind of a ceiling. And we are, I guess, also, with years of low interest rates, should ever something happen to the interest rate, then the weight of that rising household debt is really going to make itself felt in terms of the payments that people are making.
Yeah, already, even at today's really low interest rates, taking about a 3% interest rate or a 3.5% interest rate, because of the size of the debts, the amount of money going to pay mortgage and other credit card, consumer credit debt is the highest it's ever been in Canada. So it would be absolutely catastrophic if interest rates even went up a little bit, because we're already at, the numbers around 16%, and that's just above the previous peak, which was hit when interest rates were much higher. And every time that you hit a peak on that amount of money that's going to service debt, interest plus principal repayment, there always follows a very severe recession. And obviously we're already in a severe recession. So a lot of this that I wrote about 5 years ago and then a year and a half ago in the second edition is now happening, and we're kind of talking about this in the middle of the actual bursting of the bubble. And it may not feel like it in Montreal, but certainly
let's get into that, and then the rental aspects maybe a little bit later on. But I wonder,
okay,
that I found really interesting was the point you made about how in the U.S. subprime situation, people talk about Canadian exceptionalism. So let's say what happened in the US, our banks are more regulated, mortgage lending is more regulated. Therefore, Canadians believe, okay, well, that kind of an asset bubble with a hard landing cannot happen here. And then you make a point about how the CMHC comes into the market and how that affects the way that Canadian mortgage debt is viewed. And also how that plays into, based what's going on with prices. So I wonder if you could just maybe summarize that a little bit, because I never heard that connection before, and I found it was really interesting.
Yeah, there's an awful lot of misinformation out there about Canada. And so we do have subprime debt, and it's interesting. One of the first interviews I did, I talked about subprime debt, and I got a whole bunch of pushback. We don't have subprime debt in Canada. We don't make those reckless lending. We have prudent banks and all this kind of stuff. That's all just hogwash, basically. We do have subprime debt, and it's basically a huge segment of, so the total mortgage debt outstanding is 1.6 trillion in Canada, and about 500,000 is insured by the CMHC, and then there's another some amount, I'm not sure exactly lately, but it's probably about another 300,000 or so insured by the there's two private mortgage insurers who are not totally private, by the way, because they've got a government guarantee as well. But anyway, that's another story. So say 900,000 has insurance on it. The insurance, as I'm sure your listeners know, is for the lender, not for the purchaser of the assets. But a lot of people are confused on that. And what it does is the insurance allows the bank to make loans that they normally would never make. So in other words, the standards have been watered down over the years, but the bank doesn't care, because as long as it's got that insurance on it, it can make a claim against CMHC or the other private insurers, and it doesn't have to worry about the credit worthiness of the home purchaser. And the premiums are paid by the home purchaser in most cases. So the bank is basically, it was an encouragement to make the banks lend more to younger people who couldn't really get into housing any other way. And it served a good purpose for a long time, but now it's basically distorting the whole system and creating the bubble. Now in the U.S. they have a different system. They had what's called Fannie Mae and Freddie Mac, and that was one of the biggest things in the bubble bursting in the U.S. What the banks were doing there, they weren't guaranteed, but what they could do, because these quasi-governmental agencies, Fannie Mae and Freddie Mac, would buy the mortgages from the banks. The banks were fine as long as the Fannie Mae and Freddie Mac would continue to buy them. But then the whole thing fell apart when people found out how bad those mortgages were, and Fannie Mae and Freddie Mac stopped buying the mortgages. So it's a little bit different, but essentially the same. The fundamentals are similar in that people are borrowing way too much money to buy overpriced real estate. And in Canada, because of the insurance that's got backed by the government being such a large component of the total thing, the taxpayer is going to be forced to pay. So the CMHC report I mentioned that came out on 2 days ago forecast a 9 to 18% drop in house prices and a roughly $9 billion loss on CMHC. Well, the numbers are going to be much bigger than that. It's going to be more like 30 to 40% on the house prices, and it could be as much as $100 billion in all of the mortgage insurers taken together. And none of the CMHC, the government would be directly on the hook for it, and the other two mortgage insurers, the government will have to decide whether they're willing to bail them out or not. But it's going to be a massive thing. $1.6 trillion, if 10% is lost out of $1.6 trillion, which would happen in a 30 to 40% drop in house prices, that's $160 billion. So the uproar that was created by the head of CMHC is a really good guy, by the way. Evan Siddall is his name. He's the best of a lot that is very reluctant to tell people the truth. He's the one that actually has tried. Even he couldn't bring himself to mention a number bigger than 9 billion. But 10% of 1.6 trillion is 160 billion, and 10% is not a large amount. You could easily make an argument that's going to be 20%. Depending on how bad the recession gets, how much house prices go down, and all that sort of stuff.
Okay, all right. So I think that maybe gives us a sense of that the CMHC is, I mean, in a sense, like they're propped up by the government to help mitigate the risk of people who otherwise wouldn't be able to get conventional mortgages. And like, I mean, us in the real estate world, like we work a lot with the CMHC, but like, I know even for myself, sometimes my mind kind of forgets exactly what their role is and exactly who is footing the bill. We just think, okay, we're going to finance with CMHC. It's going to give us like a better rate and maybe allow us to borrow a little bit more money. But in the end, when you look at the market as a whole, what it's doing is it's propping up a whole set of buyers who maybe if the CMHC didn't exist, would not be able to make those deals that they're making.
That's right. And the thing to realize is if you went to the lender without the CMHC insurance, the discussion would be very different. Like in Germany, for example, they start at 30 to 40% down payment on a home owner occupied, and higher than that for investment properties. The second thing they do is they go through your whole life in terms of what is your family status, what is your income, what is your education, all that sort of stuff. And then they do a future projection of what your earnings are likely to be. And then they decide how much they're willing to lend you, because they don't have that backstop of the CMHC to bail them out if they make a mistake in the underwriting. So that's what the conversation would be like if Fannie Mae and Freddie Mac didn't exist in the US and if CMHC didn't exist in Canada. The conversation would be totally different. House prices would probably be a third of what they are, and probably there'd be a lot more renters and a lot fewer homeowners. And their decision was made many years ago that they wanted to encourage homeownership. And I encourage everybody to read Evan Siddall's comments. he says that this, home ownership being the be all and the end all has really hurt the whole system, and we have to stop doing that. We have to stop saying that homeowners are good and everybody else is bad. And for the property owner community that has renters, I'm sure they're much more aware of the situation with renters, and I'm sure there's lots of homeowners that are real flakes and debt up to their eyeballs, and we're gonna meet a lot of them pretty soon. Up until now, they got bailed out because house prices kept rising. They could keep refinancing all their credit cards and stuff, but that's over now. But it isn't just because somebody's a homeowner doesn't mean they're a solid citizen. And on the other hand, I'm sure there's tons of renters out there that are really good at paying their bills and not heavily in debt and model citizens, so to speak. So, but when I first started this, I got somebody who was really believed in owning properties and renting them out. And it's kind of a schizophrenic thing, really, because he was a landlord. He really believed in home ownership. And he said that renting is like taking your money, putting it in a pile, pouring lighter fluid on it, and throwing a match on it. And I thought, well, wait a minute. How can you believe that? And then you're saying that about your renters. So in other words, your renters are all idiots because they're so stupid that they're throwing away their money by paying rent to you, the landlord, right? So, in European countries, there's a much higher percentage of renters. And my thesis, if you take away the price appreciation of properties, then the cost of owning is much higher than the cost of renting. And I explained it in one of the chapters in there. It's only the price appreciation that gives the illusion that the person that is owning is better off than the person that is renting.
Okay, so I think we've had a long discussion about personal, like private home ownership, but if I can shift the discussion now maybe to investment properties and say, okay, so we discussed why there might be a housing bubble in owner-occupied stuff, and why, as the economy goes into recession, that might be a problem for people who are making those payments out of salaries that either are lower or jobs that they've lost. But so now if we move on to the investment side and we look at, obviously, like I speak from the Montreal market, and we'll get into Montreal after. But if we look at what's going on with rental prices, like the prices of rental property, do you see the same kind of bubble phenomenon going on there, or would you say that it's only concerning single family homes?
So I'm not, I feel like I'm an expert on residential real estate now, not because I knew anything about it, but when you write a book, it's amazing what you learn about. You go to write that down and then you say, wait a minute, is that right? I have to check on that. And then the next thing you know, it's like 10 hours goes by and you've researched this whole thing, which is kind of fun. I really enjoy that part of it. And but other than the calculation as to does it make sense to rent versus to own, I haven't really looked specifically into the rental property, but I did look at some of the big. So in Alberta, we have a very large real estate investment trust. So that's traded on the stock market. So that is my area. And it's called Boardwalk Real Estate Investment Trust. And there's several across the country. And you can look them up. They're quite easy to find. And if you go to the investor relations part of their website, they've got presentations and they've got a lot of information. And it's fairly easy to understand. Like you can see what their costs are and what their income is and how much per door that they spend and like everybody else, they at least the one I've researched most extensively is Boardwalk. So I'll just talk about Boardwalk. Like everybody else, they got caught up in the bubble, which is kind of surprising because in that chart that we showed, I put Edmonton on there, and you can see on there that Edmonton peaked in 2007 and has sort of been flat to lower ever since. And Calgary was a little bit different, but Calgary is also below where it was in 2007. So that's 13 years now. So, but in spite of that, Boardwalk, and I give you some idea, they have 100,000 units or something, a huge amount, most of it in Alberta and Saskatchewan. They had been paying for brand new apartments up to 200,000 or even more per door. And with the average rents in Edmonton now, rents have come down a lot in Edmonton and especially Fort McMurray, and of course they have a lot of apartments in Fort McMurray, which is a disaster, as everybody knows. So, but if you took that out, as it feeds into the average rent, you're probably looking at 1,000 to 1,100 per one bedroom, to a little bit higher for a two bedroom kind of thing. And so paying $200,000 is a pretty hefty price to pay. Now the older walk-up wood construction apartments, which makes up the bulk of their portfolio, are trading more in the 150,000 range or 140,000. And one of the things that Boardwalk does is they pay out a tremendous amount of income to their real estate investment trust holders. So the units trade on the Toronto stock market, and everybody that owns them is expecting to get a really good income. And I don't remember what the latest is. It's probably up quite high, 7, 8, 9%. But the problem with that is they're skimping on maintenance in order to, and so it's called deferred maintenance. They're skimping on maintenance in order to show the cash flow that they can then pay out as income to their unit holders. So if you think about it, a lot of people get confused with purchases because of the mortgage. The mortgage is the biggest, I agree, it's the biggest part of it. But the calculation on whether it makes sense works much more easily if you assume that you have that money. So say you assume that you have $1 million to buy apartments, and you can buy, whatever it is, 10 of them at $100,000 each, and you can get $1,000 a month in income. You're talking $12,000 a month per unit, and that's $120,000. So now you've got $120,000 yield on $1 million expenditure. That's a 12% yield. In the case of Boardwalk and the other trusts I looked at, it's about a 30% expense ratio. Now, I'm pretty sure that if you're doing it yourself, if you're a do-it-yourselfer and you own like a few units and you don't charge anything for your time, and you do some of the repairs yourself and all that kind of stuff, you don't have to pay 30%. I mean, that's a high overhead situation. But let's just use that number, 30%. Then you're talking 30% is 36, so it's rounded off to 40,000, 33%. You're now looking at $80,000 left over on that $1 million investment, which is 8% return, which is excellent. In this market, 8%. Now you can buy preferred shares that are issued by companies like Bell Canada and Royal Bank of Canada and all that, and they yield about 5%, 5 or 6%. And if you want to stretch out into the higher risk areas, you can buy preferred shares from companies like Enbridge that yield 9 or 10%. So if you could buy the apartments at $100,000 a door and you could get $1,000 a month, you're sort of above the yield that you get on Royal Bank preferreds by about 3 or 4%. But it's not a huge amount, so you still need that capital appreciation to make all your time and trouble and the risk worth it. And of course that's the problem. So, and of course the other problem with that whole scenario is, I don't know about Montreal, but in Edmonton you still can't buy these apartments. I've been watching them. I've gotten interested now. I might end up joining your club. But the 100,000 a door is kind of the number I have in my head, and people just laugh at me when I say that. I say, oh no, it'll never go that low. It's still 140, 150,000 per door. Because people still haven't given up on the dream, right? So basically, what they're doing at 150,000 a door is they're basically making less than they would make just by buying a Royal Bank preferred share, which has no risk at all and no time and no, you don't have any worries about major repairs you have to do to the roof or anything, and you don't have to run around with people leaving in the middle of the night or destroying your property or anything like that. So I think there should be a premium in that whole equation for the risk that you're taking, or if there's not that, then there should be a really good chance of rising prices. And that's the other thing. If it does get down to 100,000 per door, you've got a good chance that prices might start rising again, but we're probably a couple of years away from it getting that low. But I don't know. In Montreal, is it down to $100,000 per door, or is that unrealistic?
So let's just leave Montreal to the side for just a minute. Let me just to kind of like recap and see if I get what you're saying. So the issue happens in the rental market when people are buying not cash flow but speculative increase. Am I correct?
Yes, definitely. I went to sorry to interrupt, but I won't be long, but I went to one of those real estate forums where you pay so much per month to belong to a group, and the guy at the beginning said, "You want to get cash flow, cash flow, cash flow. It has to be cash flow positive, and don't count on price appreciation on your property and all that sort of stuff." So that was in the first 30 seconds of the first presentation. And then the whole rest of the 2 hours was basically everybody assuming that prices were going to go up, because it doesn't make sense otherwise. They did not in Alberta anyway, because our prices were way too high, and we didn't know that the oil price was going to collapse and then there was going to be this horrible recession. But even before that, the prices were too high. There just wasn't enough cushion built in there for price appreciation to cover the lack of income that you're going to make. Now I'm talking about, because I know, Terrie, when you and I talked earlier, a lot of your investors are sort of close to the ground type units, duplexes and triplexes and stuff like that. And when you get into high rise, it's a whole nother story. But it's just a terrible investment in the high rise for a number of reasons. But we could talk, if we have time, we could talk about that, how bad that is. But we're talking about just owning a significant amount of land as well as the building, and the chance for property appreciation. But you have to be careful, and the way to do it, to be careful, is to think about, you've got that money, no debt, just straight money, and compare it to what you could get in a preferred share from the Royal Bank. Right now it's 5%. It's been 5% for years, so it's a pretty good benchmark. No risk. You even get a tax break. A dividend tax credit gives you a tax break. So whatever you're doing compared to that, and then if the yield is lower than that, then you got to sit down and have a hard look at it and say, what are the chances of capital appreciation? Because that's the only other way you can get out of it with a really good return.
Mm-hmm. Okay. Yeah. Okay. So that's interesting. And then I guess that's where we kind of get the bridge between, let's say, because the CMHC obviously lends also to investors, right?
Yeah.
Like 5 doors and less, it still falls into residential mortgages. And then the CMHC is involved also in like multi-units. So in 6 doors and more, their lending criteria are different in the two cases. Like in one case, they're lending on sale price of the building. And in the other case, they're lending on economic value. But what we're seeing in Montreal, and I assume it's got to be the same across the rest of the country, is that, the valuation of economic values are kind of like this. And so the CMHC, let's say on an $800,000 purchase, depending on what the income is, might fund 500 or 550K. And then the sale price is going up. Like the sale price has become sort of uncoupled from the economic value of the building.
So how do they calculate the economic value? Is it based on rents and stuff like that?
Rents and expenses, and the CMHC like basically has, like let's say you're calculating the value of a company, right? Like you're going to take EBITDA and then you're going to do it by X number of multiples. And so the CMHC has like a similar calculation in kind of lending, but definitely there's an interesting uncoupling of the property values versus the economic values.
Yeah.
And I mean, that in itself is, it's kind of a question that begs explanation, because why is it that money keeps chasing those assets if the actual return on it in cash flow terms is not so interesting?
So at the big level, at the big level where you build these 30-story towers, the CMHC's got a similar thing. I know a couple of developers, and
condos. You mean condos, or you mean?
No, nobody's building condos anymore. The financing is terrible on condos. It's purpose-built rentals. So the CMHC's got this really attractive program, and I don't know the full details of it, but it sounds similar to what you're talking about. On if you build a high-rise tower of rental properties, but it gets even better, because then the pension plans like Ontario Teachers and Canada Pension Plan and OMERS and Caisse de dépôt, they all are willing to buy these things and they have their own way of calculating economic value called the cap rate. And the cap rates are down to 3% or even lower now. So one local entrepreneur built a high-rise tower, purpose-built rental in Edmonton, and sold it to one of the pension plans for a 3% cap rate, and then everybody just got really super excited because they this is a big win, and it would be a big it would have been I don't know, was it 100 million or something in that range? I don't know, some number like that. So it excites everybody when people see stuff like that. Now the pension plans The problem with the pension plans is they're all bidding against each other. So the thing to understand about pension plans is they've got money coming in every month, and they need to place it. And so they've got departments that they've built up over the last few years that are focused on real estate, and another department on private equity, and another part, and the only thing these people do is they have checkbooks and they want to write checks, and they're competing with each other, and it sort of works to their advantage if prices keep rising. So if a pension plan buys one building last year at 90 million, and then somebody buys it at 100 million next year, a similar building, then they can say, oh, we made 11% return on our purchase from a year ago, and they just keep leapfrogging each other. But I think that's probably coming to an end very quickly as well. So without that pension plan sort of being the kind of the ignorant money in the equation, if you like, then they call it taking a really long-term point of view, but it's just really stupidity is what it is. Then once you remove that, then it's going to be very difficult, because you're going to then get back to what you called the economic value, which I think is a really good term. And then you have to figure out, well, of all the expenses of the construction and all that sort of stuff, and the refurbishing that's required every 10 years to make the building look fresh and stuff, then you've got to earn a return comparable to the 5% from the Royal Bank Preferred, and that's the benchmark everybody should be using, but they're not using it. So even pension plans are counting in that price appreciation down the road. And this crazy thing about high rises, just to mention it, is the only thing in the long run that goes up in value, and this is so obvious that I sort of feel bad saying it, but I realize now that people get confused about these things. The only thing in the whole equation, whether it be a house or a duplex or triplex or a high-rise tower, the only thing that goes up in value is the land. The building, as soon as it's brand new and people start moving into it, it starts to fall apart. And you can show this any number of ways, but when you think about it, the building requires maintenance. It gets old, it gets beat up. It doesn't look as good as the building that's just built today if it's 10 years old. And eventually, it basically probably more money spent on refurbishing it than the original cost. So the land underneath it is the key to the idea that this appreciates.
Yeah.
And
I'm just going to interrupt you for a second. I mean, if you're looking at investment terms, the rents tend to go up also. I mean, like I think if we're talking about Montreal, like the conditions are pretty different, because like you guys, your tenancy laws are different. And I think you're more dependent maybe on the oil market, which is a bit more up and down. But definitely in Montreal, where we're so heavily rent controlled, you can assume that your rents are going to progress as well. So like the land, it will go up in value, and your rental income should increase as well. But obviously the building depreciates, and you have to be constantly like injecting funds into there to keep it floating.
I was just focusing on that the speculative component of it. So the income component on it would be that's absolutely right. The rents should go up with inflation. And now you saw in that graph we put up earlier that the inflation line is pretty flat, right? So and the wage line is also pretty flat as well.
Figure out how to just make it appear bigger if you want to. Oops! Now I muted us. Okay. Jeez.
Oh, that's yeah.
Okay, I muted us. Okay, I'm gonna hide myself.
Okay, can I hear me now? No, I can't hear you. Well, the dark blue line there is at 150, which over 20 years is about 3% inflation per year, a little bit less. It'll be about 2 point something compounded, and the wages have gone up not even double. So that would be the rent line that you'd want to look at. That's the likelihood of rent going up, because people have to pay their rents out of their wages and income.
Okay. All right. Thanks. Okay. So let's now move to, let's say, Montreal/Quebec. So I think, you mentioned in your book what we call Canadian exceptionalism with regards to the fact that we can't have a crash that's similar to the US. I think Quebec definitely has its own kind of exceptionalism where we look at prices in Toronto and Vancouver, we look at the salaries, we look at the valuations of property there, and we say, okay, they look a bit things look a bit uncoupled in those markets because the prices have appreciated a whole lot. The rents can't really go up that much more. So maybe those markets are overheated. And then we look at Montreal and we see that, our prices have been historically very low. And the kind of doctrine here is that Montreal is just in the process of adjusting to the level of other Canadian markets. So what do you think of that? Do you think the Montreal market still has room to expand, or do you think we're like everybody else?
Well, I think you have to respect the fact that it's always been lower than Toronto. Well, I think it's always been lower. I actually, that's not true. If you go back far enough, Montreal was a much bigger center than Toronto. But most people listening to this wouldn't know that. But a lot of companies moved out of Montreal and moved to Toronto, and most of the big banks were in Montreal at one time. Now they're all in Toronto, because you got to remember the main determinant of all of this is income. So the reason for living in a big city like Montreal or Toronto is to be close to a job with income, or if you're older, then you want to be close to your grandchildren or whatever. But children and grandchildren tend to spread out all different cities. So if you basically, it's the people that are paying big bucks to move into a big city is generally because they have a job there, and so the incomes that are paid, like in Manhattan, for example, $3,000, $4,000, $5,000 a month rental for an apartment, a high-rise apartment, is quite normal. But the salaries and the incomes are much, much higher there. Like, for instance, to be in the 1% in Manhattan, you have to have income. I think I saw a number. I find this hard to believe, but I'm pretty sure it was well over $1 million per year to be in the 1%. Yeah,
wouldn't surprise me. Yeah.
No, and like lots and lots of salaries are 3 or 4 million. Well, in Montreal, I bet you could be hard pressed to find more than a couple of dozen people that had salaries above $1 million. So you got to be careful that the now Vancouver's different. So just to tell you a little story, I've discovered in doing interviews all across Canada, mostly have been in Toronto and Edmonton, Calgary, and Vancouver. But I did have one interview in where I actually traveled to Montreal. I usually, or if I'm doing a talk, I usually start and say, there's going to be there's a horrible housing bubble in Canada. There's a horrible crash coming, but Montreal, you'll be fine because you're special. So and then I wait, and then people
okay,
nod.
So are we special or not? Are we special or not?
So people nod and like it's. And then I say, I'm joking. You're not supposed to believe me when I say that. I'm just joking. But really, people do believe it. And it's amazing because I find myself doing the same thing with our house that we renovated in 2009. Spent way too much money renovating. I talk about it in the book. And yeah, our house is special because we renovated it, and these other houses, and our street is special, and our location in Edmonton is special. And I even had a guy tell me he was in Calgary, he owned a condo. He was trying to convince me that the condo was special in the building, and almost all the condos are identical. But because it was a northwest corner or the distance to the elevator, I forget exactly what the combination. But of course, didn't work out. When he finally had to sell it, he actually didn't sell it because the price was so low. He just held on to it, which is another whole thing. So Montreal is special, but so is every other place special. And you gotta respect the fact that Montreal's always been below these other cities. So if you're going to make the argument that Montreal is going to catch up, you'd have to say, well, why would that gap then be eliminated? That's the question, and I don't know the answer to that. I don't know if there is an answer. I know that in Vancouver, money laundering was a huge component of the demand for housing, and now money laundering tends to look for special situations. It seems like in Vancouver, they really liked very expensive, $5-10 million houses with a view of the ocean. Not right on the ocean, but up on the hill overlooking the ocean. And since the money laundering basically stopped in 2016, when the government started demanding reporting of all transactions to the CRA, those houses have come down. I've seen ones that were 11 million in 2016 are now lucky to trade at 5 million, 4.5 million, 5 million. So if it's money laundering that's driving it, then you got to be very careful because that can move on. Another popular one is in Toronto. With immigration and foreign people coming in. Well, most of those people are what are called non-permanent residents, NPRs, and the only reason they're coming is because of jobs. And if the jobs are not there, they're not going to come. And if the jobs aren't there, they're going to leave. So that influx of humans that need to rent a place or buy a place can reverse very quickly. So that you'd have to look at the reasons why Montreal was going to catch up before you got really super convinced. It's safer just to assume that the gap was going to be the same. And then so that would, but you could make the argument though, and I think this is correct. I don't mind this argument, and I'm sure people in Montreal will like this, that Toronto has to correct by 50%. Vancouver probably has to correct by 60%, but Montreal only needs to correct by 20% or 15% because Montreal never got up to the heights that Vancouver and Toronto did. So, I would say that's correct.
But so, what if I can just back up a little bit? I guess what I hear is that be it rent prices or be it purchase prices of single-family homes, we're stuck with incomes. Okay.
Exactly.
And so it means that unless you see a similar kind of income progression, you can't continue to see the same kind of rise in house prices and the same kind of rise in rents that you would. Now,
no, you could. Sorry to interrupt. You could see it, but you'd have to recognize that it's speculation. So there's speculation. I see a comment from a listener there that, how do you explain all this demand? It's speculative demand. They're not coming in for the income. They're coming in for the future uptick in the price. And then you got to look at it and say, are these people smart, or are they like the pension plans that just have all this money they have to place, and they're not really being very discerning about what they buy and what price they pay.
Mm-hmm. And so if I may also, I think one of the things that maybe it is a bit exceptional about Montreal is because we have this rent control situation, rents are already kind of uncoupled from incomes. Because, for example, like we'll have, I don't know, like for us we count to 3.5s, but for you it would be like a 1-bedroom, and a 1-bedroom that has been occupied for the last 10 years might be renting for $500. And if that unit came on the market today, it would be worth, 800 or something, depending, 850, 900, depending on which part of the city it's in. And so I think if you look at the speculation, people maybe are speculating on the increase in property value, but I think there's also speculation going on the increase in rental values. And then we have, various tricks of how to turn over tenants and try to what we call like optimize buildings by getting around rent control rules. But that there's a kind of, on one hand, a speculation on property values, and on the other side, a speculation on the increase that you can get it in rents.
Mm-hmm.
Yeah.
But there's a limit to that, how much you can get on a rent because of the incomes. You got to be careful with incomes. Like, what is going to cause incomes in Montreal to rise substantially? That's the question. And because people could only afford so much. I think the rental market is more honest than all this other stuff. Because the rental market, you're dealing with people probably that are going to be renters for a long time. They're not necessarily always looking to buy a place. And if you're looking at the sort of the average rent, not the high priced rentals, and then you got to look at how many people, how much do they make, how much income do they have, what can they afford to pay, and then go from there. And it's quite possible. I heard a story about Vancouver years ago. It didn't used to be this hot. In fact, Vancouver was pretty. It's gone through at least 2 crashes that I know of in the last 40 years. And one of the guys from Edmonton that acquaintance of mine, I heard secondhand, bought a building and he's become very wealthy. And the building was full of drug dealers and prostitutes. And so he went to the local police station and he said, would you guys mind, at the end of the day when you have to write up all your reports on what you did? And he said, yeah. Well, how do you do that? He said, well, we usually sit in our car and do it. He said, well, would you mind just parking your car in front of that building over there and write up your reports there? I'd really appreciate it. I don't know if he bribed them or not, but anyway, it doesn't matter. So of course, the people that were in the building, their business went to zero if there's a police car out front. Nobody wanted to be seen buying drugs or going to visit anyway. So he got all the people cleaned out of the building. Then he fixed it up a little bit, re-rented it to more normal people, and was able to make a really good profit. So there's always anomalies like that in every city. And in the case of rent controls and that, I don't know what the legislation is in terms of getting people out of there. But there's a couple of fortunes were made in Manhattan, one in the Bronx and one in the Queens. One was headed by a family called Kushner, and one was headed by a family called Trump. And now the two families are merged together, and they live in the White House. And but the Kushner family, they own thousands and thousands of rent-controlled apartments in the New York, and it'd be worth looking into actually for people that are interested in this. But when the government gets involved in low-income housing, the government has a whole bunch of rules that they require the landlord to meet, and so the whole game is about breaking the rules without getting caught. So Kushner Sr. got caught and ended up going to jail for several years because he was caught. And Donald Trump's father, Fred was his name, got caught, but somehow he managed to not go to jail. He had always in a constant battle with City Hall in terms of and the legal department in terms of the stuff that he was doing, which was trying to get around these rules, because it was hard to make a living on all these apartments if you fully complied with the rules that they were talking about. So anyway, that's kind of the model. But I think that's a decent model. But again, your problem is that you're competing with people that are going to break the rules, right? So you gotta be, if you're an investor that wants to do the right thing for the tenants and spend the money to keep everything up to code and all that sort of stuff, then you have to charge a little bit higher rent, and then the people that have to decide your building is better than the other guy's building who's cutting corners and stuff like that. So we're going to see that in because of the COVID-19 crisis, we're going to see a huge change in the nursing homes, senior homes. There's going to be massive inquiries and new legislation coming in terms of what is allowed and what isn't allowed, and the costs of those things, which are already quite high, will probably go even higher. The government will probably end up perhaps getting involved in owning those properties. I don't know.
Okay. Okay, so I think maybe that's like a nice segue into just our last question. We're kind of running out of time. So I don't know if you have an opinion on what the result of the COVID crisis is going to be. Like, do you think that that's going to be an accelerator in terms of popping of the bubble? Do you think that's going to be like the moment of our grand reckoning, or what's your prognosis on what's about to happen?
Well, I think we were headed for a recession in Canada even before COVID-19 hit, because we had the big downturn in the energy sector, which, all the banks say, oh, we got less than 5% exposure to energy, but that's not the whole story. The whole story is that the energy exports are very important to the Canadian economy. So we were headed into a recession. In fact, my numbers showed that if people want to subscribe to my weekend note, it comes out on Friday. They can find me on Twitter at HMACBE, HMcB. And then you can see the note will come out tomorrow on Twitter, and there's a link there, and then you can subscribe to it for free. And but the downturn in Canada actually started amazingly. Actually, started shortly after the election in October. So arguably you could say we were in a recession in December, January already. When history is written, though, it'll be the COVID-19 recession, I'm sure. But no, it's a very serious recession, and it will burst the bubble. The bubble is going to burst anyway, but we'll never know, because this will be the bursting of the bubble, and it'll affect different parts of the country differently. But everybody's going to feel it pretty dramatically. The government's going to have to spend a lot of money to try and replace the incomes that people are missing out on, and the deficit, the federal government deficit, was going to be 20 or 30 billion. Is probably going to be 150 to 200 billion. It never happened before. So there seems to be a bit of a pause right now, maybe because the stock market went back up from the March 23rd bottom, and people are thinking, oh, maybe this is over. We'll find a vaccine, we'll find a cure, and then we'll go back to normal. But my opinion is, no, it's not going to happen. The COVID will be with us longer than that, and the numbers that come out. So the second quarter numbers end June 30th. So we're just about to start the last month of the 3 months, and the estimates, they keep downgrading the estimates, and now the estimates by large economic forecasts are for a 40% annual rate decline so that would be 10% in one quarter. So that never, just to give you an idea, the global financial crisis, which everybody thought was the worst you could possibly have, was 4% from top to bottom decline in GDP. So we're talking, like, we're going back if you think about it, if GDP grows at 3% a year, and say it declines by 12% this year, and say some smaller amount next year, we're going to go back 5 or 10 years to where our GDP. Now we all managed to live, back with a GDP that was 10 or 15% smaller. 10 years ago or whenever it was, we all managed to get by. But the people that get caught are the speculators, the people with too much debt, and there just isn't enough money, flowing through the system, circulating in the system, for them to be made whole, and they end up defaulting, which is the debt deflation theory brought out by Irving Fisher in 1930s, that it becomes a cascading domino effect and causes a whole bunch of foreclosures. So if you're looking for the bottom on this, which I'm sure everybody will be, don't get too excited about the bottom until you start to see a large number of foreclosures of people that can't handle their debts, and probably a big name bankruptcy. In 1990, it was Olympia in New York, you might remember, and this time I don't know who it's going to be, but some big institutional, either a private sector company or even a government situation. Like in 1998, Russia defaulted on their debt. That was a signal. There's always one or two. In 2009, General Motors and Chrysler both went bankrupt. Those Lehman Brothers. I mean, those are the kind of things. So we're still early days yet. We haven't seen much of that yet. We're sort of in I call it the Wile E. Coyote movement, where he's gone off the cliff, but he still thinks that everything's okay because he hasn't looked down yet. Yeah.
Exactly.
So this is the moment we're in.
Yeah. Okay. So I want to ask just one more question. Either I'm going to ask it, or I'll see if if there are any remaining questions that you guys that felt like didn't get addressed in the talk. Do we have any more questions from the spectators? No? Okay. Well, then I'll ask it. So if you had just like a 30-second advice or a soundbite for people who are committed to real estate as an asset class and rental property, what do you think would it be like a wise move for them at this time?
Well, I think it depends on the situation. Like if you're sitting with cash or borrowing power, in other words, you're not fully invested yet, wait until you see people losing properties to foreclosure, and then you'll get some really good bargains, and the timing could be great. And I still like the idea of that $100,000 per door, but maybe that's unrealistic. But on the other hand, if you're one of those people that has expanded a lot and has quite a bit of debt and owns multiple properties, and you're not sure if you can make it through this downturn, if you kind of need the downturn to be mild and things not to get too hairy over the next 6 to 12 months kind of thing, I would encourage you to consider scaling back, and that means probably selling. Might even mean selling at a loss. I don't know, but certainly if you can sell at a profit, build up some liquidity, and make sure that you've got that cash. Because the big winners, and there's not going to be very many of them, the big winners in the next 5 years are going to be the people that have the cash or the relationship with the bank, where the bank will lend them a lot of money, and they can step in and scoop up some of these properties that are going to be let go at really cheap prices.
Well, great.
I'm hoping to be one of them myself. So.
Well, that's exactly the advice that we got from many people who are more optimistic about what's going to happen in the real estate market. So if the pessimists and the optimists give us the same advice, which is try to stay liquid, maybe we should listen to it. Okay, well, look, Hilliard, I think we're out of time. So I'm going to say thanks so much for taking the time to do this interview. And I think there were some really in your book and also in the talk today, some perspectives that maybe we don't hear so much in the real estate investment world. And I think whether or not we agree with your overall prognosis, I think there's some interesting data points to consider when you try to understand what's going on in the Canadian market. So.
Yes, well, it's been a pleasure. Thanks very much, Terrie.
Okay, thank you.